We have been looking at kind of broadening our exposure, both from a geography perspective, from a cap perspective, from a sector perspective. And the good thing about ex-US and small cap stocks is that universe is a bit more cyclically tilted.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street. I'm Jim Worden, the Chief Investment Officer for the Wealth Consulting Group. I'm delighted to have Shannon Saccocia, Chief Investment Officer for Wealth at Neuberger Berman, joining us today. Welcome, Shannon.
Thanks for having me, Jim.
Shannon, we bumped into each other a couple times on the conference scene last year. I think it was in LA a couple times, and then Florida maybe once or twice. You've been busy traveling. I see you on TV often. Tell me first maybe about your journey, how you got to Neuberger Berman, and what that journey was like and what you're doing now. And then we can talk about the markets and go from there. Does that sound good for you?
Sounds great. So yeah, my journey has been, an interesting one. I started off coming out of school, and my intention was actually to be pre-med. I wanted to be an epidemiologist, which, back in the 90s, most people didn't know what that was. And so we really had a heyday with epidemiology and COVID. But, my goal was kind of coming out of college just to get my foot in the door in the finance industry. I hadn't been focused on that in school, and so started off, as I think many people do, in a large bank. I was on the custody side, and really felt that I wanted to pursue a path that was closer to the end investor. So I joined the RIA world back in 2006, when I feel like it was still in its infancy in terms of relevance in working with private clients. Was in multiple RIAs over the course of several years, spent some time in private banking, and then came to Neuberger 2.5 years ago, really to focus my efforts, continuing to work with private clients and small institutions, but also to be able to really have more of a hand in creating solutions for the types of clients that I've served for 20 plus years.
Wow, that's great. That's a great summary. So tell me about the types of clients that you're working with. How has that changed? I mean, I know the private client side, I'm familiar. I used to work for a large bank. I kind of get that, but tell me how that may have changed a little bit over time. Is it still the same? Curious.
Sure. I mean, I think, even when I started back in the industry, 20 plus years ago on the RIA side, obviously being in the industry since 2000, but first working with private clients, it was really that, kind of traditional outgrowth of the brokerage model. We talked a lot of individual stocks. Did we like Procter Gamble or, better than Unilever? And, if you were, sort of adventurous during the early 2000s, you might have a little international exposure. Perhaps you had some China in your portfolio, but a lot of clients really were US based, large cap equities and fixed income, in many cases municipal bonds, and that was the way that asset allocation decision was really just at the highest level. How much did you have in cash? How much did you have in fixed income? How much did you have in stocks? And so, as my career has unfolded, I think there's really been two changes. Number one, in terms of the desired outcomes and the complexity, most clients still want to use the simplest solution to create the solve for their problem. But I think increasingly there's just been so much more access and availability of really strong institutional thinking that's being applied to private client portfolio construction. And I think it's been great to not only have the additional tools that we've been afforded over the last 20 years, but more importantly, applying that same type of discipline that institutions apply to building those portfolios. I think that the combination of that has led to stronger outcomes for private clients.
And it's interesting because I feel like a lot of the things that clients have access to now, and they don't even need to be like ultra high net worth, but a lot of things that they can do now, they couldn't do before, right? So, I mean, there's this, I guess we kind of call that the democratization of investments, whether that's alternatives. And now you have things that, maybe are liquid and I guess you can consider those alternatives too, but different types of things. And then with private markets, I know you spend a lot of time looking at the private markets. What excites you the most and what scares you the most about all that? It's a lot.
Yeah, it's certainly a conversation that becomes a bit more nuanced when you're talking with, first and foremost, individual and family investors. But, perhaps more importantly, these are investors that typically pay taxes. So if you think about the types of strategies that are available, both in the public and private space, because, we allocate across public and private, really thinking about what's the best type of solution for clients, there's a few more levers that you need to pull in terms of what makes that best solution. I would say your point on access is well taken. Historically, if we go back 20, 30, 40 years ago, it was only the largest institutions that had access to top quality managers. And, that was really a limited set. And so you didn't have, if you had access to private investments, whether equity or credit or non-correlated alternatives, in many cases 20 or 30 years ago, those would have been inferior strategies, probably not run by institutional teams. And so now having that access is great. I mean, you want to be able to have access to the broadest possible universe, especially given the shrinkage that we've seen in the public equity space. But more importantly, there are nuances to incorporating private markets exposure into portfolios that require a little bit more time. It's not just the fees, it's not just the liquidity, it's the experience of investing in privates. And I think that that's something that requires that additional level of education. But it's not that dissimilar to other changes we've seen, Jim. I mean, you think about when
Yeah.
ETFs were launched initially, nobody really understood, what that was. I mean, you think about a mutual fund even. So I think it's just yet another example of the innovation that is, just so important in the financial services industry, but also the education that needs to go along with that.
That's such a good point. That kind of takes me back in time. I started back in the late 90s and I remember I worked for a wirehouse at the time and people were talking about spiders. What is a spider? It was a S&P 500 and it's all simple now, but like back then it's like, how is this different than a normal unit investment trust and the fees and trading it? So yeah, like and we are all about educating clients and educating advisors because there's a lot going on. There's crypto assets, there's ways to, and it kind of scares me a little bit because there's a lot of ways to express your views. And in some cases, clients don't even work with an advisor; they do it on their own. It's a little bit scary, especially if they start dabbling into things like silver, and then we see what can happen when the tail starts wagging the dog, as it were. But what do you think about that in terms of like just this evolution and educating clients? Like how's the best way to do this? And obviously most of the people listening to our podcast are our advisors in the community, people that we know, but there might be some do-it-yourselfers that might occasionally listen. What do you have to say to them in terms of like how to best approach these things?
I think it just comes down to the return and risk profile, right? If you think about what does private equity look and feel like to a client that you might be talking to? Well, it looks and feels a lot like equity, right? Just with this sort of different time horizon and liquidity. So, I mean, a successful private equity company is similar to a successful public equity company. They, drive free cash flow, they drive revenues, they increase the operating value of their business, they have a strong competitive advantage. So I think sometimes we spend a lot of time on the focusing on the differences between
Hmm.
private markets and public markets investments, and I think sometimes it's better to kind of focus on the similarities and understanding the profile. I mean, you talk about private credit, private debt. There's a lot of different flavors of that in terms
Yeah.
of duration profile, credit risk, underlying issuer diversification. So I think it's understanding sort of what and then there's speculation, and I think it's important to understand that there are some clients with whom you may be working that want to take that additional level of risk and are interested in perhaps things that are kind of out on the frontier, in terms of potential speculation. And then it becomes about portfolio construction and sizing and making sure that understanding what they own and what they want to own is incorporated into your overarching allocation. So I think the miss maybe for some advisors is that they don't think about that. That's outside of the managed pool that they oversee. But it's really
Yeah.
important to make sure that you're incorporating that so that you know the risk level for your client. It also helps to understand their tolerance and understand their goals if they can be transparent with you and open about the things that they might be investing in on their own.
I really love what you said there because I feel like just generally speaking, it's always better to, identify what we have in common rather than focusing on the differences. Especially, I mean, politically, we sometimes, look at the differences and highlight the differences, but yeah, there's really more in common than is different. So that's nice to hear. Now, as you're talking about clients and sophistication, and I guess part of it is like we have a lot more information, and we have AI that's a few years old now, but like there's a lot of information that people can get and do research on their own, and then they can work with advisors. I spoke with a higher net worth client the other day, with an advisor, and they just wanted to hear thoughts on the markets, thoughts on the economy, and there was a lot of focus on AI and what's happening. And so, like, I feel that the education, it's more accessible now probably than it was 10, 20, 30 years ago. A lot more accessible, and they can see that. But so Shannon, what are your views on kind of the creating an optimal portfolio? I know you and I were on a panel talking about optimal portfolios, but that was roughly a year ago, I think, down in LA. What do you think about it now? Has anything really changed? Does it look the same? What are the opportunities that excite you? What are the things that kind of scare you a little bit, maybe?
So I think that just our overarching view is that with the underlying fundamental economic momentum, we still do believe that risk assets can perform well this year. I think one of the areas that we have been emphasizing for the last 18 months is this desire for allocations to move away from the concentration in AI. And that it's not just technology, right? We have parts of the utility sector, we
Mm,
have sort of adjacent data center exposure that feels very very AI focused. And so what we've been trying to do is really think about, if you have a reaccelerating global economy, there are sectors that are quote unquote more cyclical that would potentially benefit from that. And so the other thing we've been looking at is just this lower interest rate environment. We're continuing to see the Fed is likely to cut rates again this year. We have seen rates move lower outside of the United States, Europe and the UK, for instance. And so, what are companies that might potentially benefit from just kind of a just true lower rate environment in terms of, financials, lending. Also, are there, will there be this real reacceleration in M&A activity based on this fundamentally improving business confidence? And so we have been looking at kind of broadening our exposure, both from a geography perspective, from a cap perspective, from a sector perspective. And the good thing about ex-US and small cap stocks is that universe is a bit more cyclically tilted. So you don't have as much mega cap technology as you do obviously in the S&P 500. And so just by diversifying into those areas, you're sort of naturally getting this complementary portfolio. And then within fixed income, we have been focused on the fact that a lot of these economic and policy cross currents are creating shifting currency dynamics. They're creating some shifting dynamics in terms of particularly central bank sovereign and government demand for different types of issuance. And so we're looking at taking advantage of some of those shifting relationships and the changing paradigm to get a bit more, I would say, active in fixed income. I think most private clients have a core bond portfolio of some kind. That is probably the vast majority of their fixed income exposure, but being able to complement that around the edges. And then obviously we've talked at length about private markets, but along that same theme, we've had a drought of distributions. Activity has been muted over the last few years, and we've seen a pretty market inflection higher in announced M&A transactions, for instance, which should bode well for those distributions for LPs that have been waiting to get some of their capital back over the last couple of years.
It's interesting when you talk about fixed income. I mean, this is an area that I'm a little bit more concerned with fixed income than equities. I manage some equities directly, quant-driven strategies, but on the fixed income side, we've gotten a little bit more conservative. And I guess part of that is because, when we had the last major risk on event, bonds didn't behave exactly the way we thought that they would behave. And I'm talking about high quality, longer duration bonds. And we also aren't super excited about high yield bonds. I mean, we like them tactically, but like as a buy and hold, we're concerned about spreads being tight. How do you position fixed income? Like when you're talking to your clients, what do you like? We like active too. I feel like active management and just looking where are those areas. And we talk to some of our strategic partners and they like areas of mortgage-backed securities, but within liquid, what are you liking there?
Sure. I mean, I think the to your point about bonds behaving like bonds. I do think that this is the year for that. I think we'll get, kind of true higher quality investment grade portfolios, whether that's usually a combination of government and credit. We think they do provide that diversification benefit now that the curve has normalized and that we're getting into more of a steady state in terms of both central bank policy, but also fiscal spend. So, not that I feel like we aren't concerned about the absolute level of fiscal spend, but I think we're not expecting a meaningful acceleration there. So with that as the backdrop, I think where we're looking is just number one, again, there are some opportunities outside of the U.S. in non-U.S. developed and emerging market debt. I think those are areas that most investors are probably a bit underexposed to right now. We're looking underneath the covers in terms of municipals, for instance. So while perhaps U.S. government debt is a bit range bound. I mean, you're clipping a nice coupon there, but probably not seeing too much movement. Municipals are still very attractive from an after-tax perspective. And then I think more tactically, you saw, for instance, the big buy of MBS by Fannie Mae and Freddie Mac. Those types of events, create opportunities for some shorter term dislocations. Sure. And so having a multi-sector, multi-factor solution alongside a core bond portfolio, a lot of times it doesn't make sense to move cash bonds in a really tactical way. There's as you probably are aware, a decent amount of slippage there, depending on
Yeah.
how much you're moving and how quickly. So having a complement to that can be more, kind of multi-factor, I think is important. But again, I think the risks that you speak of in the fixed income market are actually where we also see opportunity on the other
Mm.
side. So, and then just the all in yield is much more attractive than it was prior to COVID.
Yeah, that's
And
true.
so, if you're guiding you're guiding portfolios for perhaps investors who have retired or don't have, cash flow, or are looking to create and generate a certain, kind of base level of income, that's easier to do now than it was 5 or 6 years ago. And I think that we maybe lose sight of that with some of the policy cross currents. But
Mm.
I think it's important to understand that there is still kind of good quality fixed income available at a still attractive yield in this environment.
That's a good point. I mean, I feel like maybe we get a little bit anchored, just the human biases that we have, that emotional biases that I'm still thinking about 2022 and how bad that was for bonds, and we had last year was okay, but like I just I'm a little wary of taking too much duration. Maybe that changes. Maybe we get back to normal, as you say, and that becomes less of an issue because your starting point yield is higher, and to the degree that the Fed maybe cuts a couple times, once or twice, maybe three times, if the labor market weakens some, then that's good, right? Then we should, some areas of the curve would benefit from that. But that's interesting. And then, so your thoughts on private credit? I know there's a lot of money that's gone in there, and there's some funds that have gotten just very, very large. Like, how do you navigate that? We don't have a whole lot, by the way, in private credit, so we don't really have a dog in the fight, if you will. But like, when you're looking at that and you're representing, Neuberger Berman, and looking to see where should you go, where should you play, and obviously it's going to depend on clients. Some clients need full liquidity, but what do you look at when you're doing due diligence and you're reviewing, opportunities and risks?
I mean, I think it's number one. It's a very big space, and there's a lot of definitional divergence in terms of private credit, private debt, and so I really look at it in terms of two categories. One, what I would call traditional corporate direct lending. So that's really alongside a private equity manager and a private equity
Sure.
book where you're lending to those underlying companies. I think that's where you're seeing maybe a little bit more concern over the last few days. I mean, there's some concerns about the software component of that universe. But I think that just comes down to kind of true underwriting of the potential growth opportunities in those companies, and thinking about it as just being part of the capital stack for innovative businesses. I think that's the way that you look at corporate direct lending. It also tends to be a little bit longer duration, so 5 to 7 years. So it's that
Hmm.
expectation of future growth with some protection relative to the equity, right? If you're comparing it from a capital perspective, and then you have asset based credit, and asset based credit is more cash flow generative on an ongoing basis. You're getting those interest payments, tend to be shorter duration, tend to be collateralized by pools of receivables. So underlying that, perhaps that you don't have there's a diversification element that you might not necessarily have in every corporate direct lending portfolio, but there's also kind of differing risks, right? And so how much yield pickup are you looking for there? How much of a premium are you looking for? Then you have to start thinking about even more so, what is the kind of covenant tenor of that underlying debt? How much of it is consumer? What's the quality of that consumer? Business receivables are perhaps a little bit more interesting, but there still can be variability in that. And then you have kind of the true assets that you're whether it's royalties or kind of fixed assets that you're lending off of. And so that those two together, Jim, I think that you can toggle kind of that duration and credit quality across the universe. And again, it's really about, there is more specialization occurring in the space. And so, but I think for our views, you do want to make sure that, number one, people understand that there's still a lot of demand for this. Banks are not involved in lending at these levels, and they're not likely to jump back into that fray at this juncture. And so small businesses in particular really benefit from private credit. But number two, it's like anything else. You've got to know your issuer, you got to do your research, and you got to know the managers that are managing those underlying issuers and doing that underwriting.
Yeah, that makes sense. Well, and I know some of these deals, they can work it out too, right? So if there's some distress, it's not like a typical bond that's, you're in default and game over, right? But like there's workouts, right?
Mm-hmm. Yeah, absolutely. And I would say that tool and the toolkit for those managers is important. But it comes down to all the same things that you would look at, honestly, in the public credit market. If you're getting a really high yield relative to the market, there's probably a reason for that. You probably want to dig into that, and how is that collateralized, and what's the payback, and what is the workout opportunity. But that's all at the manager level. And so I think once you determine where you want to be on that scale, from sort of asset-based credit, short duration to midterm duration to corporate direct lending, deciding where you want to sit yourself from a portfolio construction standpoint, and then looking at the manager, I think probably makes the most sense.
Interesting. Do you guys have a view with, you mentioned a little bit looking outside I feel like a lot of people are looking outside of the Mag 7 and mega cap, and they're looking to small caps, they're looking to international. Do you guys have a view on the dollar? Where does the dollar weaken? Does it stay kind of volatile? Does it strengthen?
Yeah, so we don't see a lot of upward pressure on the dollar, just from the dynamics that we see from a geopolitical perspective. We're also, we're the European Central Bank, the Bank of England, probably holding firm in the near to midterm on rates. They're probably done cutting rates, and then you look at the Bank of Japan, and they're raising rates, and so we're the ones still moving the rates lower.
Yeah.
So that's just kind of just a relative
Sure.
relative relationship. But I think we're definitely in the stable to weaker dollar camp, which, as you know, for U.S. investors, that can be a tailwind for investing outside of the United States. And so, but I would say, we just where we don't see a lot of pressure is really for a stronger dollar, at least in 2026. There aren't a lot of factors that would point to that.
Interesting. So Shannon, as you're sitting down with some of your clients that you talk with, what are some of the things that you've discovered that might be beneficial to tell all of the other clients? Aside from diversification, I feel like we all know diversification, but sometimes we need to have that discussion again, especially if clients hold like 20% of their portfolios in NVIDIA, but. What are some of the conversations that you've had that you think you've learned that clients sometimes make the same mistakes, and obviously probably separate out some of the pensions and endowments and whatnot because they're different. But I'm just talking about like individuals. What do you think?
I think large institutional investors sometimes make mistakes too. So
Yeah.
I don't think that's just a private client challenge. So
what are their mistakes, and what are the retail client mistakes?
I think that in an environment, we've had an extraordinary 3 years of returns, and that actually came pretty soon after another strong 3 years of returns in 19, 20, and 21, right? So both of those periods had 15+% return to the S&P 500 over every year for 3 years. The last time that happened, and the only other time in the last 70 years that happened, was in the late 90s. So which again, we're not making that specific comparison, but I think that's why you see the comparison. So I think one of the challenges, and the way that I have been continuing to talk about this with clients, is that there is a perception that, this AI megatrend, this large scale theme, is one that you want to have exposure to. And I couldn't agree more. I mean, we
Hmm.
definitely agree this is a longer term trend. There's going to be, winners, and you're going to see a kind of similar innovation cycle to what we saw with the internet in the 2000s. However, I think what the challenge is that over the last couple of years, there's been sort of a proverbial easy button in terms of investing in this theme. And now what you're starting to see is you're actually starting to see dispersion in terms of how investors are looking at the spending, and in terms of how investors are thinking about who's going to win this game. There's still a number of very um, I would say, important private companies that have a stake in this story somewhere. And so I think what I'm encouraging clients to do, and this is on institutionally and with private clients, I speak to both in my role,
Hmm.
is really think about where's the next phase of this trade or theme going. And it's really going to be very similar to what we saw in the 2000s, which was, the spending and the supply by tech companies translated to demand spending for companies outside of the tech sector. And so just thinking about at the fundamental level, what companies can benefit from productivity enhancement, what companies, more importantly, longer term,
Hmm.
can actually incorporate AI technology to help them grow their business and become more competitive. Productivity enhancement is it's the first thing, right? But it can't be
Yeah,
the only thing, because there's
sure.
a declining kind of marginal utility to that.
Mhm.
So you need to be able to identify companies who can utilize AI, utilize data, utilize it in terms of
Hmm.
being able to create growth in their business. And
Sure.
Jim, that's harder, right? It's
Yeah,
harder to find those companies. It's
yeah.
harder to think about that because they're not used to kind of putting that type of free cash flow to work. It's going to be a lot about capital allocation and management decision making. There
Hmm.
are going to be sacrifices that need to be made in those businesses to fund the implementation of AI. So I would just encourage people. It's not okay. You should diversify your portfolio away from these technology winners because we don't believe in AI. We actually
Hmm.
just know that the value over the next number of years is likely to accrete to a broader swath of companies, and you want to make sure that you have access to that, but understanding that there is going to be, just as we're seeing right now, dispersion in those enablers, you're going to see dispersion in the adopters as well. And so really knowing what you own and spending the time to research that both on the public and private side is going to be critical.
Oh, I love it. I feel like that this is kind of like we start off with the rising tide lifting all the boats, and now it's like there's going to be some winners and there's going to be some losers, and there's going to be companies in between that do okay, that they maybe don't do as well. But I love what your point is about growth, because sometimes we look at valuations and we say, okay, this is fairly valued, or sometimes we look at growth and say, well, they're still growing, and some of these companies might keep growing by a lot, and so you're okay paying a little bit more for it. But then we have to be careful if the dynamic changes, if they can't grow, like you said, if they're cutting costs, margins can improve, revenue can improve, their growth, but like you can't just keep getting more and more productive and costs keep going down, right? So something else has to happen. I love your comment on that, because like I feel like, yeah, how do you use AI to grow? How do you use it to whether it's a healthcare company, a biotech company, discovering new cures for diseases. If you can reduce your R&D, so that's an expense, but if you can do things to affect the growth side of the balance sheet, that makes a lot of sense. And then I guess the way we look at it is like, how are these companies that maybe they're not even adjacent to AI, but now they have some tools, they have a new toolkit that they can use to and control their inventory a little bit better, bring their costs down. Maybe their headcount doesn't need to increase as much. But then again, I feel like what you're saying is like the companies that benefit the most, they're gonna use it multi-pronged. We're gonna grow through it. We're going to expand their market through it. I feel like there's a lot of interesting things there.
Yeah, there's definitely, I mean, it's just, I think it's going to be, um, it's every innovation cycle we see disruption, right? And whether we're seeing that in terms of slower hiring for entry level workers, or we're seeing it in terms of, the potential for software companies to have fewer seats, and therefore, that great recurring revenue stream is perhaps lower over the next 5 years than it has been over the past 5 years. I think there's just a lot of ways to look at this, but the momentum that AI has, and there's already solutions that are resonating in all of our lives that make things easier. And so I feel like you just need to be able to sort of embrace this innovation and disruption, and then again, the risks that are created on the other side, there's always an opportunity, and it's just being able to find it.
Well, and then there's probably more jobs that are created that we don't even know what those jobs are going to be, right?
It
So,
happens. Yeah. I mean, if we were talking in 2009, 2010, 2011, we'd be talking about all the job losses in
yeah,
mortgage related industries, right? Those jobs were filled with other things. And so it's really, many of those people kind of ended up on the private credit world, right? So
yeah.
there's always opportunities, right? And so I think that's the important thing, and why you work with an advisor, and for many of you who are advisors, this. I mean, the value, and Jim, you were talking about this earlier, the value is no longer in providing facts, because everybody has access to
Sure.
information. It's providing the reasons why those facts matter, and
Hmm.
separating the noise from what really matters. That's the role of the advisor and the role of investment managers, and I think we need to embrace that, especially in this environment where things are changing so quickly.
Shannon, do you and does your team at Neuberger Berman, do you guys ever kind of, well, not, I don't want to say forecast, but do you ever look out on the horizon, maybe 5, 10, 15, 20 years, and just look at what's happening with demographics? There's a big wealth transfer happening. AI and technologies making it to where we don't need to, we don't need to have the same um, headcount in certain types of industries. And, so there's other jobs that are going to be created, but then I feel like there's some forces that are kind of deflationary when you look at the aging demographics, and then I hear Elon Musk say work is going to be optional. We're all going to be wealthy. That's like way out there, and maybe data centers out in space. But do you guys look at that and analyze, like, how do we get there, and what does it look like? It's not in a straight line. Sometimes it's a little bit messy getting there. But do you guys ever have any concerns about, like, income inequality, or just wealth inequality, and where the money is, and demographics, and all of these things kind of combine?
Absolutely. I mean, I think some of the fiscal sustainability concerns that, you talked earlier about, that created a lot of volatility in the long end of the treasury curve, for instance, last year, a lot of that is seated in, the acknowledgement that costs have gone up. We have, kind of a meaningful amount of spending that is non-discretionary, essentially, for the US government. And that's only going
Mm,
to be exacerbated over time with demographics. And then you overlay that with things like, medical
mm,
discoveries, like what's happening with GLP-1s, and
yeah.
everyone's healthier and potentially living longer, but they're snacking less. And, perhaps that has implications for, dining out and food and beverage
Mm,
companies. The demographic tailwind that, for instance, like India enjoys, is a headwind in China and the US and in Europe.
sure.
And with will immigration policies, for instance, what will that do to the average wage in the United States? Does that increase the average wage? Does it lower it? What?
Yeah.
So yes, absolutely, the answer to your question is 100%.
Hmm.
We look at all of that, and I think we look at it not only from like an individual, kind of company, sector, industry, geography perspective, but we also look at it in terms of, again, to your point about income inequality, for instance, how does that drive fiscal and monetary behavior? How does that potentially impact our expected returns that we factor into our
Mm,
capital market assumptions, which then are used to underpin our kind of financial planning that we do for
sure.
clients. So I think it's really important that, you take a step back and understand that while some of these changes, especially things like one-time policy announcements or a flare-up in geopolitical tension, they aren't necessarily going to move the market in the short
Hmm.
term. The underlying trend does, right? If you look at the rearmament of Europe, for instance, and the
Mm,
necessary kind of industrial thrust. If you go back to COVID, for instance, and look at all of the accelerated retirements within the manufacturing sector during COVID,
yeah.
how do you going to fill those workers when we have sort of an under enrollment, if you will, in trade education? So all of those things are demographic, like they're interesting to me as an economist because that
Yeah.
is my background. But then applying those to how does that affect building portfolios? How does that apply, the
Hmm.
way that a portfolio I would build for someone who's 65 today, would I build that the same way 10 years from now for a 65-year-old with longevity being the trending the way it is? Probably not, right? So I do think that all of these things are really important. It's important to understand the short to midterm, but it's also important to understand the very long term, because our clients are going to be around for a long time, and we've got to be with them and meet them where they are.
That's true. And like you said, if we're taking these drugs for weight loss, we're healthier, we're living longer, and like there's more cures for diseases, then like and then if we're not going to have anyone, the demographics aren't working in our favor, and we're not going to have more immigration. Like, yeah, I feel like there's just a lot. As one of the things I look at, Shannon, is um, the labor force participation rate and the number of people that are not working. Some of those people are retired, but there's a lot of people there, and it's basically this almost the same level as where we were at with COVID. So there's like 102 or 103 million people that are not in the workforce. And if some of those people decide to get back in at some point, then yeah, are there going to be the jobs, and like what happens with unemployment? And so what does the Fed do, right? Does the Fed
Right.
continue to support that? They have. I would expect that they would, but it's fascinating times that we live in.
Mm-hmm. Absolutely, absolutely, and I think they're all valuable questions, but they also have a number of different potential outcomes. And so I think as investors, that's the most important thing, is that you can't over anchor to any one of those
It's true.
outcomes, in order to make sure that, again, you can deliver that long term goal.
Well, this has been a fantastic conversation. I really, really appreciate your time. Was there any question I should have asked you that but I didn't?
I think, the one thing that I just continue to get from clients, and you sort of alluded to it, but is that, how does portfolio construction, how has it changed, how will it continue to change and evolve? And I think that, again, the way that I answer that is that, capital markets are always evolving. If there's one good thing about investors, is that we try to uncover new opportunities and
Hmm.
new ways to potentially make money on every day,
Yeah.
every month, every year. And so I think that the most important thing is to understand that we are in a period of innovation and disruption, and that comes in not only what we're investing in, but how we're investing in it. And so I feel like now you're just, there's going to be a cornucopia of available strategies over the next 5, 10, 15 years, and really being open to learning more about them and understanding them and understanding how they can create solutions. I think that's the most important thing. It's not about whether the 60/40 is dead or alive. It's not about active versus passive. It's about all of those things, but really focus much more on like true portfolio construction and aligning that to desired outcomes. I think is going to be so valuable over the next 5, 10, 15 years.
What a great way to end it. And that makes me feel good because I feel like, people will still need advisors. They're still going to need financial professionals. We're not all going to be replaced by robots, at least not anytime soon.
No, I don't think so. And understanding that we provide as much EQ as IQ for our investors and our clients, I think that continues to be the emphasis for us.
Yes. Well, thank you, Shannon Saccocia, so much for your time. And yeah, I'll probably bump into you again at the conference.
I look forward to it, Jim. Thanks again. I appreciate it.
Take care.
Here's Three's Company too. Come and dance on our floor. Take a step that is new.